Welcome to your personalized deep dive.
Oh, cool.
Yeah. So today we're going back in time to the year 2000,
Okay.
the peak of the dot-com bubble, to explore Warren Buffett's letter to Berkshire Hathaway shareholders.
Oh, wow.
Yeah, it's fascinating how a guy known for being so level-headed navigated such a chaotic time.
Right.
We're going to uncover some gems in this letter
Okay.
from his thoughts on unconventional acquisitions.
All right.
Think bricks and carpets, not just tech,
Interesting.
to why he dislikes CEOs predicting growth rates.
Okay.
And we'll even touch on a Wall Street Journal error that had some real-world consequences.
It's remarkable how those insights from 2000 still resonate in today's market.
Yeah.
Like a lot of the same patterns keep repeating themselves.
Right. Okay, so first we have to address the elephant in the room, the dot-com bubble.
Yeah.
The S&P 500 took a hit that year.
Right.
But Berkshire Hathaway still managed to outperform it, with book value per share increasing by 6.5%.
Wow.
But here's the kicker. Buffett considered his stock portfolio only mildly attractive at that time.
Really?
It makes you wonder, how did he pull that off?
Well, what's fascinating is that Buffett achieved this by focusing on acquiring entire businesses, a strategy he clearly favors.
Yeah.
He compares valuing stocks and businesses to the bird in the hand analogy.
Okay.
Essentially, a known quantity, a bird in your hand, is more valuable than the potential but uncertain birds hiding in a bush.
But wasn't Buffett known for investing in companies like Coca-Cola? That seems more like betting on a whole flock of birds, not just one in hand.
That's a great point. But even with Coca-Cola,
Yeah.
Buffett saw a proven track record of success and a strong brand.
Right.
He wasn't betting on risky startups with unproven business models, those birds in the bush that everyone was chasing during the dot-com frenzy.
Right.
He saw inflated valuations in the tech sector as birdless bushes, all hype and no substance.
Oh, wow.
So think about your own portfolio. Are you chasing risky, high-growth birds in the bush, or are you focusing on solid, reliable companies that are like birds in hand?
Okay, that analogy makes a lot of sense.
Yeah.
So while everyone was chasing those dot-com birds,
Right.
Buffett went on a bit of a shopping spree, acquiring 8 businesses that year.
Wow.
Companies like Court Furniture Rental and even Acme Brick.
This mix of acquisitions really highlights his contrarian approach.
Right.
Instead of following the tech-obsessed crowd, he was picking up stable, profitable businesses.
Yeah, and the story behind the Court acquisition is amazing.
Oh, is it?
It all started with a single-page fax.
Really?
A friend of Buffett sent him a fax about a failed buyout attempt, and within days a deal was struck.
Wow.
It seems like he really has a knack for spotting an opportunity.
Yeah.
But why the focus on acquiring entire businesses?
Well, there are a few reasons,
Okay.
including some tax advantages.
Yeah.
When Berkshire owns 80% or more of a business, they can avoid double taxation on dividends and capital gains.
Oh.
It makes their returns that much more attractive.
Ah, smart move. So on to another crucial piece of the Berkshire puzzle: insurance. The letter breaks down this concept of float,
Right.
money that insurance companies hold but don't own because premiums are paid
Yeah.
before losses are incurred.
Right.
The key is having low-cost float.
Exactly.
Ideally, you want to earn more on your float than it costs you to maintain it.
Right.
Well, it looks like 2000 wasn't the best year in that regard.
You're right.
Yeah.
Berkshire experienced an underwriting loss,
Yeah.
leading to a 6% cost of float,
Wow.
higher than their usual target.
Yeah.
But they attributed this to factors like retroactive reinsurance
Oh.
and a challenging pricing environment.
So speaking of which, retroactive reinsurance sounds pretty complex.
It is.
Maybe we should break that down for our listeners.
Yeah, definitely.
Yes, please explain.
Okay.
It sounds like something out of a textbook.
Okay. Imagine you're an insurance company with a bunch of old, potentially costly claims still hanging over your head.
Yeah.
Retroactive reinsurance lets you offload that risk to Berkshire for a fee. It's a win-win because Berkshire gets to put that money,
Yeah.
the float, to work while waiting for the claims to play out.
So it's like they're taking on someone else's problems,
Right.
but in a way that benefits them in the long run.
Exactly.
Clever. And then there's Ajit Jain,
Yes.
the reinsurance guru at Berkshire.
Right.
Buffett seems to sing his praises every year.
And for good reason.
Yeah.
In 2000, he secured a massive reinsurance deal with a UK company
Wow.
and even insured Alex Rodriguez's record-breaking baseball contract against disability.
Oh, wow.
He also insured a potential billion-dollar prize for Grab.com, an early internet company.
Really?
It seems he has a talent for finding these unique and perhaps overlooked opportunities.
Now, shifting gears to Geico.
Yeah.
The letter shows impressive year-over-year growth in their auto policies.
Right.
They're a real powerhouse for Berkshire.
Yes, but they did hit some bumps in the road in 2000.
Oh, really?
Their customer acquisition costs increased, and Buffett admitted he'd misjudged the effectiveness of their increased ad spending.
It's refreshing that he's so open about his mistakes.
Yeah.
It makes him seem more human. You know?
Definitely.
Yeah.
He analyzes the reasons for this setback.
How they-
Saturation in certain media markets.
Right.
Stricter underwriting due to rising losses.
Mm-hmm.
And a curious decision by State Farm to keep their prices low despite rising costs across the industry.
That doesn't sound like a very sustainable strategy.
Right.
What was State Farm thinking?
It's puzzling even to Buffett.
Yeah.
He acknowledges State Farm's success,
Yeah.
but he believes their low pricing strategy can't last forever.
Hmm.
He's confident Geico's low-cost model will prevail in the long run, even if State Farm makes some unusual choices.
It's interesting how, even when analyzing a setback, Buffett extracts an important lesson.
Yeah.
He criticizes what he calls a never-look-back culture,
Okay.
where companies avoid dissecting their mistakes. He contrasts this with the Washington Post company's practice of reviewing acquisitions 3 years after they're made.
Interesting.
Think about a time you made a mistake in your own investments.
Hmm.
Did you take the time to analyze what went wrong? What lessons did you learn?
That's a great point. I know I'm definitely guilty of sometimes wanting to just brush my investing mistakes under the rug,
Yeah,
but taking the time to analyze them is so important.
absolutely. And that's particularly critical in a dynamic industry like insurance,
Yeah.
where things change constantly.
Right.
Now, this next part is a bit of a wild ride.
Okay.
The Wall Street Journal published a story claiming Berkshire was buying bonds from a struggling company called Conseco.
Ah, yes. A story that turned out to be not entirely accurate.
To put it mildly, Buffett sets the record straight, making it clear he never bought those bonds.
Wow.
The impact of this false report was significant.
Right.
Conseco's stock price jumped solely based on this rumor.
Oh, wow.
It just goes to show the power and the danger of unchecked reporting, even from sources we consider trustworthy. Yeah. It's a cautionary tale for all of us.
Right.
Always verify information before making any investment decisions, no matter where that information comes from.
This incident with the Wall Street Journal really highlights something else. Buffett feels strongly about the danger of hype and speculation.
Yeah.
And speaking of hype, nothing gets Buffett more riled up than CEOs making long-term growth predictions.
He really does have a strong opinion about those predictions, calling CEOs who make them congenital optimists or even charlatans.
Yeah.
Why is he so against CEOs making these long-term growth predictions?
Well, imagine you're a CEO and you've just publicly announced that you expect 20% growth next year. There's a lot of pressure to deliver on that promise, right?
Definitely. I could see how that could lead to some bad decisions.
Exactly. Buffett has seen CEOs cut corners on quality, fudge the numbers, or make risky bets, all in the name of hitting those growth targets. He'd much rather see CEOs focus on building a strong, sustainable business that's a far more reliable path to long-term success, both for the company and its investors. So when you're evaluating companies, pay attention to the leaders who prioritize solid fundamentals over flashy growth projections.
That's a good takeaway for any investor. Okay, so let's dive into Berkshire's actual performance in 2000, starting with their core insurance operations. Besides giants like Geico and General Re, they have a whole collection of smaller insurance companies, right?
Yes, and those smaller companies actually performed quite well in 2000, generating a healthy underwriting profit and adding significantly to Berkshire's float. It's a good reminder that sometimes the less glamorous parts of a business can be the most reliable.
So it's not just about the big names, but having a diversified portfolio of solid performers.
Yeah.
What about the manufacturing, retail, and service businesses? How did those sectors do?
They mostly held their own, but there was one notable exception.
Yeah, shoes. They've been a challenge for a lot of companies over the years. What happened there?
It seems like a tough business to crack. Buffett specifically mentions Dexter Shoe, a company he acquired back in 1993 as a mistake. And he's pretty candid about it. He says he compounded the error by using Berkshire shares as payment, essentially giving up a piece of a valuable company for a shoe business that wasn't performing.
He even wrote off all the remaining goodwill associated with Dexter Shoe, admitting there was no economic goodwill left. That's got to be tough to swallow, but it shows he's willing to own up to his mistakes.
Exactly. And despite the challenges, he expresses admiration for the managers at the shoe businesses, recognizing their dedication and hard work in trying to turn things around.
It speaks to the loyalty and commitment within the Berkshire family. So we've talked about a misstep. Now let's talk about a sector where Berkshire is really excelling. aircraft services. They have flight safety and executive jet,
Yeah.
two companies that are leaders in their respective fields.
Absolutely. Flight Safety, led by the octogenarian Al Welchi, is the top pilot training company, while Executive Jet, with the dynamic Rich Santulli at the helm, dominates the fractional ownership market for business jets.
Buffett seems to have a real soft spot for Awolchi, even joking about splitting his age in half when he reaches 100, and both companies are investing heavily in their future. Flight Safety's been spending big on flight simulators, while Executive Jet is expanding rapidly in Europe.
It's interesting that Buffett, who's known for being a frugal investor, sees so much value in these capital-intensive businesses.
I guess it comes down to recognizing a good long-term bet when you see one. They operate in niche markets with high barriers to entry and prioritize safety above all else, which is crucial in aviation. And it's not just talk it. Buffett himself, his family, and many Berkshire managers are regular users of NetJet's Executive Jet's fractional ownership program.
It shows they believe in the product and trust the company they own. They have skin in the game, so to speak. Now, before we move on to Buffett's fascinating look-through earnings concept, let's touch on a hot topic in 2000, accounting for mergers.
Yes, the whole debate about pooling versus purchase accounting was pretty contentious back then.
It was, and Buffett, in his usual straightforward manner, laid out both sides of the argument, acknowledging the strengths and weaknesses of each approach.
He even expressed satisfaction that the Financial Accounting Standards Board ultimately opted for an alternative approach that he found more sound. It shows that even accounting rules can evolve and improve over time.
And the fact that Buffett took the time to explain this complex issue to his shareholders demonstrates his commitment to transparency.
Speaking of transparency, I found his explanation of look-through earnings quite brilliant. It's not a term you hear every day, but it makes so much sense.
It does. It's a way for Buffett to provide a clearer picture of Berkshire's true economic performance because simply relying on reported earnings doesn't tell the whole story. Traditional accounting only reflects the dividends Berkshire receives from the companies they own, not the full earnings those companies are generating, and those dividends are often just a small fraction of the total profits.
So Buffett created look-through earnings to capture Berkshire's share of the undistributed earnings from their major holdings. It's like getting a sneak peek into the future earning power of those investments as those undistributed earnings contribute to the growth and value of those companies.
It's a much more holistic view aligned with his long-term investment philosophy. He's always emphasizing the importance of looking beyond the short-term ups and downs and focusing on the core strength of a business.
Essentially, look through earnings. Let investors see past the limitations of traditional accounting and grasp the bigger picture.
Exactly. It's a testament to his intellectual honesty and desire to provide shareholders with a clear, comprehensive view of Berkshire's operations.
Now, for a little detour into a subject Buffett tackles in his letter Full and Fair Reporting, it's a pretty scathing critique of how some companies communicate.
He definitely doesn't mince words. He criticizes the use of jargon, the tendency to obscure things with the vague accounting, and the reliance on public relations spin.
He prefers CEOs who can explain things simply and honestly.
Right. He even applauds the SEC's crackdown on selective disclosure, where certain investors got an unfair advantage by receiving information before others.
Everyone should have access to the same information at the same time.
It creates a more level playing field. And then there's his take on CEO predictions, which, as we discussed, he's not a fan of.
He's highly critical of CEOs who make long-term growth predictions, calling them congenital optimists or even charlatans. He believes those predictions create pressure to hit targets, which can lead to some shady behavior.
Think about it, cutting corners, playing accounting games, even outright fraud, all to make those numbers look good.
That's a scary thought.
It is. Buffett warns investors to be wary of leaders who prioritize hype over substance.
It's a timeless lesson, especially relevant today, with certain tech companies making grandiose claims about their future potential.
Focus on the fundamentals, be skeptical of the hype, and do your own research.
Speaking of being wary, this next story is quite something.
Ah, yes, the Wall Street Journal incident where they reported falsely that Berkshire was buying bonds from Conseco.
The company was already struggling, and of course their stock surged based on that rumor.
Buffett was not happy about that. He uses it to highlight the dangers of unchecked reporting, even from well-respected news sources.
He makes a strong point about the importance of using accurate language, especially when it comes to financial news.
He suggests using the word rumor more freely to prevent misinformation from spreading.
It's good advice in today's world of instant news and social media. Knowing what's true and what's not is more important than ever.
Absolutely. We need to be critical consumers of information regardless of the source.
Okay, before we wrap up this part of our deep dive, I want to share one more story. It's a bit nostalgic, but I think it speaks to the importance of mentorship and lifelong learning. 50 years before writing this letter, Buffett took Ben Graham's class at Columbia, and it had a profound impact on him. He credits Graham's teachings with drastically improving his investment approach.
It's amazing to think that even someone as successful as Buffett acknowledges the impact of a great mentor.
It shows humility and a willingness to learn from others, which are essential qualities for any investor, regardless of their experience.
It underscores the value of finding mentors and being open to new ideas, even if they challenge your existing beliefs.
Now, are you ready for a look at shareholder-designated contributions and maybe even a glimpse into the Berkshire Hathaway weekend festivities in Omaha? Let's dive into something that shows a different side of Berkshire, something a little more heartwarming.
Okay.
The letter talks about their shareholder-designated contributions.
It's a unique program that empowers Berkshire shareholders to directly influence where a portion of the company's charitable giving goes.
Oh, wow.
They get a say in making a difference.
So in 2019, almost 97% of eligible shares participated with contributions totaling nearly $17 million. That's incredible.
And get this, over the program's 20-year history, Berkshire has donated a massive $164 million based on shareholder instructions. It's a testament to the generosity and engagement of the Berkshire community.
It really speaks to the values Buffett has instilled in the company. Giving back and making a positive impact clearly matter to him.
It's inspiring to see. Now we can't talk about Berkshire Hathaway without mentioning their legendary annual meeting. It's become this huge event.
The Woodstock of capitalism, as they call it, in 2000, they had to move the meeting to the Omaha Civic Auditorium to accommodate the growing crowds.
And it sounds like it was quite the experience with product showcases, discounted shopping baseball games, even a bridge tournament.
Wow, it must feel like a huge celebration of all things Berkshire, a chance for shareholders to connect with the company and each other.
Of course, the main attraction is the question and answer session where Buffett and his partner Charlie Munger spend hours fielding questions from shareholders.
Imagine the insights you could glean from two of the greatest investing minds. What a privilege to be in that room. So, as we wrap up our deep dive into Buffett's 2000 letter to Berkshire Hathaway shareholders, what are your biggest takeaways?
For me, it reinforces the power of sticking to your principles, even when the market is going haywire. Buffett stayed true to his value investing approach, buying great businesses at reasonable prices. He didn't get caught up in the dot-com hype.
He's a great example of how patience and a commitment to lifelong learning are key to success in investing and in life.
And I'm always struck by how he combines that sharp business mind with strong ethics and a real desire to give back. It's a powerful combination that makes him such a compelling figure.
Before we go, we'd like to leave you with a thought to ponder. Imagine it's 2000 and you are leading Berkshire Hathaway. What would your next move be?
Would you jump into the dot-com craze, focus on acquiring more businesses, or forge a completely different path?
It's a fascinating question that challenges you to apply what we've discussed today to your own investment decisions and even to your life.
Thank you for joining us on this deep dive into Warren Buffett's world. We hope you found it insightful.
Until next time, keep learning, exploring, and investing in yourself and your future.